The issue that we believe there is some bipartisan support for is a tax reform package focusing on the idea of making the U.S. the most competitive it can be globally. There's a strong concern that the U.S. is handcuffed by its own tax system, that we are not as globally competitive as we should be. And one of the reasons for that, given, and I think it's accurate, is to say we use the so-called worldwide system of taxation. The worldwide system of taxation essentially says that a corporation headquartered in the United States or a U.S. citizen is taxed on its worldwide income. That means whether the income is earned in the United States or, for example, in France, that person will be taxed on that income wherever it's earned. On the other hand, all of the other G7 nations other than the United States and the vast majority of economically developed countries use what's called the Territorial Approach. That Territorial Approach says we'll only tax income in the country in which it is earned. So from my prior example where the U.S. business is doing, the U.S. corporation is doing business in the U.S. and in France, France will also tax those profits as well as the United States. So you'll have the same identical income taxed twice by two different jurisdictions. And so as a result, the United States then has to have an elaborate foreign tax credit system to allow U.S. corporations to get a credit for the tax that's paid over to France. That raises the complications aspect and makes us less globally competitive. So as a result, if we were to focus and decide that the territorial system was worthy of consideration, and we really put that on the table, I think what would happen is we would see there would be a much stronger and freer flow of cash and investments and people between countries, and would make us much more globally, I think, competitive. In addition, it would take away many of the abuses that people perceive are taking place now. For example, the idea of corporate inversions that's been in the news the last couple of years, where U.S. corporations are acquired by or let themselves be acquired by or acquire a subsidiary in a foreign country, and therefore all those profits are then taxed in that foreign country, usually at a low or no rate, and is not taxed, those earnings are not taxed in the U.S. until they're brought back, that is, repatriated to the United States. Similarly, there are U.S. subsidiaries that are created of U.S. corporations that are incorporated abroad in low or no tax countries. Those earnings are parked over there, never taxed in the U.S. until they're brought back. And so you have huge amounts of cash on deposit and unused to stimulate economic growth in the U.S. because those earnings are being held in reserve and held abroad and therefore not available to the U.S. corporations because they fear the tax consequences.